Everyone. My name is Adrian Ramirez, and I'm the Associate Director of the Career Development Center and also the Interim Coordinator for the Money Management Center. And we want to welcome you to the spring 2022 semester and to listen in for the Money Management Center with a great community partner we have, Noble Credit Union. And I want to welcome them, both Mariah and Martin, and they'll both introduce themselves. And we look forward to hearing about how to navigate insurance. So, thank you so much for being here, Mariah and Martin.
Thank you, Adrian. Thank you for that welcome. I'm Mariah Walton, and I work for Noble Credit Union. I'm the community relations specialist. So my job is basically to kind of create some financial wellness topics and get the message out, and just let everybody know that if you have any questions, Noble can answer them for you, regardless of whether you are a member or not. But I do want to introduce Martin. He is my partner in crime here today, and in a lot of our projects outside of this particular seminar.
Oh, people are just saying hello to you in the chat. So just so everyone knows, the students can go ahead and ask questions in the chat feature. I was going to explain that after our introduction, so yeah. We'll continue that in a second.
Okay, no problem. But I just wanted Martin to introduce himself really quick, because he's also a fellow Fresno State student and works for Noble, and he does a great job. So I just wanted him to say a few words.
All right, well, welcome everybody. My name is Martin Gomez, and I'm part of the business development team. Before COVID started, I was kind of known as the DoorDash of the credit union, because my whole role is to go out, meet all of you. I know a lot of times it's difficult, especially with school, with work, everything that we have to deal with in daily life. So I try to make it so I'm the one going out to you. So if you ever have any questions, I'm hoping, as time goes, I know right now it's difficult with the pandemic still going on, but we do offer virtual appointments where, you're able to actually Zoom in with me, even if you're at school, at home, however, your life is dealing, and you can talk with me as if you were going into a branch. As myself, I am actually a current student. I'm majoring in forensic behavioral science and minoring in art. So, I know how it is with the daily grind of work and school, and then not having enough time to get to a financial institution. So if you ever have any questions, please feel free to reach out to me.
Well, thank you. Thank you so much, Martin, for your introduction, and go dogs, right?
Everyone. Go dogs.
Okay, go dogs. All right. So this is how it's going to work. Mariah is going to be giving the presentation on insurance, and we'll be listening in. We'll be available. So you can ask questions in the chat feature, and Mariah will answer the questions throughout the presentation, but she wants you to wait for answering the questions that you proposed in the chat until the end. So we'll look at that. We'll have time at the end to take a look. But in the meantime, before we get started, though, I also want to make sure that students know that the Money Management Center is on campus, and we're available. We're in the Thomas building and room 104. So if you come into the Frank W. Thomas building, you can make an appointment with one of our Bulldog financial coaches, which is a peer coach, which will give you financial information and tools for you to help make good decisions, financial decisions. And and then all these events that we host throughout the semester. So take a look at your calendar, look at your emails, and plan accordingly, and we'll go from there. So thank you, Mariah, for being here today.
My pleasure. All right, let me try and share my screen here, make sure I've got it all. Okay, we still on the right page, Adrian?
Yes, you're good now. Mm-hmm.
Perfect. Okay, so as you all know, we're going to talk about insurance, and a lot of people ask, well, what does that necessarily have to do with my budget? But it really does, because there's all types of insurance, and then there's all kinds of costs, and there's all different ways you can insure yourself and your belongings. And it sounds boring, but it's really not as boring as everybody thinks. But basically, insurance, I think academically we all know, it's just a mechanism for protecting us against losses and damages against or associated with unforeseen events, fires, theft, vandalism, things like that. And it is a necessary evil. We do need to have insurance, especially when it comes to healthcare. You don't want some type of catastrophic health issue coming, and then you're left bankrupt with medical bills. But there's four basic types, right? We've got our health, our auto, our home, and life insurance. We all know about those biggies, but there's all kinds of other types of insurance as well. And you maybe want to think about that as you're moving ahead in your career and maybe starting a family or buying a home. And that's kind of what we'll talk about. And you may or may not need it. It just depends on the life stage that you're in. So for example, people may want to think about if you're starting a business, you're going to need business insurance, workers' comp insurance, commercial auto insurance. If you are a pet lover, you may want to invest in some pet insurance so that next time you take Fido to the vet, it's not going to cost you 10 grand. It's going to cost you $1,000. You may also want to think about life insurance and long-term care insurance, which kind of coincides with that life insurance part. Renter's insurance, if you're having an apartment or a home that you're renting that's not yours. Travel insurance, if you're going abroad, especially in this COVID area, if you end up having to cancel your flight or whatever, you'll be able to get all of those monies back. And they've even been able to write policies for an accidental alien abduction. So insurance carriers will cover anything if you want them to. They've been known to cover death by laughter, lack of taste buds. If you might be a victim of kidnapping and ransom, there's insurance policies for that. There's all types. Julia Roberts insures her smile for $30 million. Mariah Carey insures her voice for $25 million. And Daniel Craig, James Bond, he insures his entire body for $9.5 million. So if you can dream it up, insurance carriers will create a policy for you. But you can go overboard and you really don't want to. So we're just going to go focus on the 4 main topics today, and I'm going to kind of tell you why you need them, why that price is determined, and how you can save money, and then maybe think about how that fits into your budget, and maybe how you maybe want to add that or remove that from your budget currently, just depending on where you're at. So we all know we need auto insurance. It's a state law, and it's pretty much a state law in all 50 states, but the prices of our premium, which is what you pay every month, they'll vary from one end of the spectrum to another. And it really depends on a wide variety of factors. And one of them is going to be your driving record. So the better your record, the lower you're going to pay monthly. So if you've had accidents or traffic violations or tickets, your insurance rates are going to be much higher compared to somebody who has a perfect driving record. So even though we want to run that red light or maybe, get somewhere in a hurry, think about that, because it takes 3 years to get that ticket off of your record before your rates will return back to normal. So be really, really cognizant of your driving and how you do it and whether or not it's worth it. Another factor is how much do you use your car. So the theory is the more you drive, the higher incidence for an accident or traffic violation to occur. So if you are a person who commutes from Visalia to Fresno State every day versus somebody who rides their bike to Fresno State every day, you will be paying a lot more in insurance, or if you're just like a social driver or whatever. So if you have a job that makes you commute, think about that. And your prices will increase, but maybe if you have a car that's of lower value, that will kind of counteract that higher premium. So there's lots of ways to get around that, but I just want you to think about this for right now. And then location, where you live also determines your premium price, fair or not. So for example, if you live in a big city versus a rural area, you're going to be paying a lot more because of the higher incidence of crime rate. They're more prone to vandalism and theft and accidents just because there's a denser population center versus somebody in a rural area where there just aren't as many cars on the road and the crime rate is lower. Something to consider too, especially in larger metro cities like LA or New York, where you park determines your premium. If you park in a secure garage versus on the street, you will pay less because the incident of a vandalism or a hit and run or smashed windshield probably won't happen if you're in a secured garage. So ask your insurance carrier what those policies are. If you get a premium and you're like, hey, that's too much money, why is it so high? Ask them. That's their job to tell you, and don't feel bad about it. Another determining factor is going to be your age. And that's just the reality. For somebody that's been driving for 10, 15 years, they're going to be paying a lot less than somebody who just got their driver's license an hour ago, because they have a proven track record of driving defensively or perfectly or avoiding accidents versus a 16-year-old kid who just got their license. There's no track record, there's no performance history there. So they're gonna make that teenager pay a lot more versus somebody my age. Interesting enough though, the older you get, starting in your 70s, then you start paying more for premiums because your reaction time is slowed and diminished. And insurance companies know that, so they will charge you more for it. Your gender also determines your policy premium, and fair or not, women will pay less for auto insurance. It's just been statistically shown that they have fewer DUIs and they get in fewer accidents. And the accidents they do get in have less injuries and cost less money. So just because you are male, you will be paying more money. You can't really negotiate that aspect of it. Another thing that will consider or influence your premium is the type of car you drive. If you're driving a brand new Corvette right off the lot versus an 84 Toyota Corolla, guess who's going to be paying more in insurance? And it's because of a variety of things. You're going to have the engine type, maybe there's safety features, how much does it cost to repair or replace, things like that. So when you're buying a car and you're thinking about your budget, don't just think about the monthly payment on the car loan or how much gas it's going to take to fill up that car, but you're also going to want to factor in the cost of insurance. And because you're taking out a loan payment and you don't own that car outright, the lender or the bank, credit union in this case, is going to require that you have comprehensive insurance because you don't fully own that car. The bank does. And they're going to want to make sure that their investment or their risk that they took on you is protected. So you will pay more for comprehensive insurance versus just your basic insurance policy. So when you're shopping for a new car, that's great. Safety features are awesome. Fancy Corvettes are even more awesome, but you do need to think about that as well. It's not going to just be gas, registration, and loan payment. It's going to be the insurance as well. Another option, and you'll hear that this credit score thing is going to follow you for the rest of your life, y'all. You have to have a good credit score. And this is going to protect you. Now, I mean, credit score affects everything. It affects what apartment you can get in, what house you can get in, what type of loan you can get in, what type of interest rate you're going to pay. In this case, for auto insurance, the insurance carriers use it as a statistical tool, and it predicts your likelihood of whether or not you're going to file a claim and what the likely cost of that claim is going to be. So the higher your credit score is, the lower your premium will be. So credit score is everything. And if it's not perfect right now, that's okay, but you do want to strive to improve it. And this is just one of the reasons why. And then the last thing that helps determine the policy or the premium is the type of coverage. And I kind of touched on that earlier. What are the limits on your basic auto insurance policy? Is your limit $300,000 or $1 million? Obviously, if you have coverage for $1 million, you're going to be paying much more than if your coverage is $300,000. And what type of policy options are you implementing? Are you adding collision? Are you adding comprehensive? Are you adding gap insurance? All those things are going to be adders that will increase your monthly payment to insurance. And then another thing, lastly, to consider is the deductible amount. So the higher your deductible, the lower your premium, and vice versa. The lower your deductible, the higher your premium. So for example, the standard deductible is $500 or $1,000. And what will happen is if you get into an accident and your car is damaged, and let's say the damage amount is $3,000. If you have a deductible of $500, the insurance is only going to pay you $2,500. If your deductible is $1,000, insurance is only going to pay you $2,000, which is fine. It just depends. So if you're driving a car that has served you well, is paid for, is easily repaired, or you don't really care what it looks like, maybe you want to have a higher deductible so that you don't have to pay as much every month. But if you have a brand new car that's got some really cool features, safety features, some lights, I don't know, really nicely tinted windows, you're probably going to want to protect that investment. And so you're probably going to want to have a lower deductible so that insurance will pay more of it. So just think about it. You may or may not need a higher or lower deductible. And it just depends, like if you think you will be in a place at the time when that accident occurs, if you can afford that amount or not. So think about that. When it comes to types of auto insurance, there's going to be three basics that you are required to have: property insurance, liability, and medical. And when you're shopping around for insurance, I recommend that you get 3 different quotes. One may be from a direct insurance agent themselves, maybe from a broker that shops around for you, shops around various insurance agencies, and online. And then make sure those policies that you're getting quotes on are the same. Make sure you're comparing apples to apples and not apples to bananas. You want to make sure they're exactly the same and read the fine print. One of the best comparison tools that I've come across is called thezebra.com. And you can click all the features that you want, all the add-ons that you want, and then it populates different insurance agencies and gives you an estimate. And then you can kind of pick from there and follow through and get a little bit more details if you want. But basically, property is going to be damage or theft to your car. Liability is going to be your legal responsibility to others in case of an injury or property damage. So if you get in a car accident, it's your fault and you hurt somebody, that's going to be where liability comes in and takes care of that. And then of course, medical is going to be the actual cost of treating those injuries. And you can have limits of how much you want to pay for that. When you're employed, and if you have to drive on the job, most employers are going to require a minimum level of coverage. So they will ask you to provide proof of that. So that may be a consideration when you are budgeting as well. How much does my employer require me to have? Am I going to have to drive on the job? Things like that. Some optional insurance pieces are going to be uninsured motorists. Even though we're required to have auto insurance in California, doesn't mean that everybody does have it. So this is kind of a nice thing to have. And even if they have it, it may not be enough to cover, right? So the uninsured motorist is going to reimburse you when the accident is caused by somebody else and they don't have enough coverage. So that's kind of a nice little protection for you if you feel like it. And it's really not that expensive. Collision is going to provide coverage against theft and damage caused by an accident, such as if you hit a tree or a guardrail or something like that. So collision is when you hit something. And then comprehensive is going to be theft and damage caused by an incident other than a collision. So a fire, flood, vandalism, hail, falling rocks and trees, other hazards like that. And again, comprehensive most likely will be required by your lender if you're making payments on that car. Now, one thing to think about too is once you pay your car off, ring up your insurance agent and say, hey, I don't need comprehensive anymore. Can I lower this to a basic policy? And that will save you money immediately. By the time your next premium is due, it will be much, much lower. So yay for no car payments and yay for a lower interest payment or interest bill as well. Glass coverage, this is kind of iffy and you'll want to talk about it. Most insurance carriers these days are now providing glass coverage. So let's say your windshield gets cracked or things like that, that's usually covered. But other types of glass coverage are going to be like your back window or your side windows, things like that. Personally, I don't think anybody needs it. Gap insurance is something that you may or may not want to consider, and it's really important to understand what that is. When you're buying a brand new car off the car lot, let's say it's $30,000, the second you drive off the car lot, and I mean the second, your car automatically drops in value either 20 or 30%. So let's say the 30% mark for today's discussion. As soon as you drive off the car, your car is now worth $21,000, or drive off the lot. Your car is now worth $21,000 instead of $30,000. Let's say you get the car home, you get in the next morning to go to work, somebody hits you and the car is totaled. Your insurance company is only going to pay you a maximum of $21,000, even though you owe or paid $30,000. So now you've got this gap of $9,000 left that's not covered, that you're still responsible for to the lender. So that gap insurance is going to cover that. It will cover the $9,000. It'll give you a check for whatever that gap is. And of course, the gap's going to get smaller and smaller as time goes on, but it's something people need to think about, especially if you're not, handy mechanic wise, or this, if you are really concerned about your finances, this is a really good way to protect yourself. So it's called gap insurance. And then of course, the rental car is another option. I would be careful about this because a lot of times Your credit card will cover rental car insurance. A lot of times you can get it through the rental car company itself. You really need to, when you consider about whether or not you should add this to your policy, consider how much it is every year. Consider how often you're actually going to be renting a car. If it's 1 or 2 times a year, maybe it is cheaper just to get the insurance policy through the rental car company or have your credit card company cover it. You really need to figure that out. A lot of times they'll throw these little extras in that maybe you're covered somewhere else for, maybe homeowners or something like that. So you want to think about that. And if it's not that much, or if it's less expensive than what the rental car company charges, that's great. But those are little items or ideas that you need to think about as you're paying for your insurance and as you're picking what options you want to add. I know that my credit card company covers a rental car, so we don't have it on our auto policy at all. And some other types of things that I forgot to mention, but I just kind of assumed everybody just has one car. But the more cars you have, you know, you'll pay more, but if you bundle everything, it'll save. And we'll talk about tips on that too. So saving money on car insurance, this is kind of fun. So like I said earlier, you want to get at least 3 different quotes, make sure they're the same, make sure that you're comparing apples to apples, and you really want to read that fine print. I would always try to find a quote on the internet. I would try to find a quote from a direct agent or from a broker. I've had my personal history, I've had the best experience going through a broker. And a lot of times also you may want to think about if your employer may offer an insurance policy, like they may have a deal like with Fresno State. I think they do California Casualty. And if you work for Fresno State, because you're an employee, you can go through California Casualty and they have negotiated rates with Fresno State so that it may be cheaper or less expensive versus going through a different car agency. So look and see what type of employee or employer benefits are offered. And that may be a good way to compare costs as well. And then compare costs before buying a car. I mentioned this earlier. It's not just about gas and registration and the monthly car payment. You're really going to want to see how much that's going to bump up your insurance premium and make sure you can afford it. Because premiums are based on the car's purchase price, the cost to repair it, its overall safety record, and the likelihood of it getting stolen. So it may affect whether or not you want to buy a new car or a used car. And it's really worth shopping around and getting that information before you sign on the dotted line for a new car. And you may want to raise the deductible. Again, I talked about this earlier too, but as a rule of thumb, if your older car is worth less than 10 times the insurance premium, having collision or comprehensive coverage may not be cost effective. And so to find out whether or not that's true for you, you're going to want to compare that. So maybe go to Kelley Blue Book or the National Association of Auto Dealers or TrueCar, and you can enter in your car and all of its features, and it will help you determine its current market value. And then you can take that information and use that when you're considering buying a new car. Or if you have an older car and it's really not worth fixing up, or you don't mind that it has a couple scratches on it, maybe you want to consider raising that deductible so it will lower your monthly premium. I buy nothing. My husband loves to buy cars from Copart where they're salvaged or damaged. He fixes them up and he flips them. And so I never drive a new car, never have. That works for our family because he knows how to fix cars. If you don't know anything about cars, maybe you do want a new car so that you don't have to worry about those maintenance issues and it's worth the extra premium for insurance. It all depends and it's all a personal decision, but it's something I want you guys to be aware of. And then of course, if you bundle things, everybody knows that, that will save you money. So if you have 2 or more cars, if you bundle your homeowners and your auto policy, it'll save money. If you're a longtime customer, they will do a multi-policy discount, things like that. You're going to want to maintain good credit. Again, credit. It's going to follow you your whole life. Just make sure it's good. And the better your credit, the lower or the less you will pay. Another thing to do, and a lot of people, especially this particular demographic, they hate picking up the phone and talking to somebody and asking for a discount. They're just wholly intimidated by it. I personally think it's a game. I love doing it. So pick up the phone, ask for a discount, ask for that good student discount, ask for the low mileage discount. See if there's a discount if you decide to carpool to work, if there's multiple cars. Is there a discount if you take a defensive driving course? Maybe we did this with my son. He went down to Long Beach and we called the insurance company, like he's barely driving it. He can't take his car to campus. So they lowered his insurance because he's away from school. It was called away from school. So you have to call. And one thing too that you really, really want to remember is you want to call every year and make sure that you're paying for what you need and nothing that you don't need. And a lot of times insurance rates will just silently creep up year after year after year with no other reason than they can. So if you call each year and say, hey, why did this go up? I haven't had any traffic accidents. I haven't had any traffic tickets. What's going on? Then they can help you find ways to lower your premium. They do not want to lose you as a customer. It costs them more to gain new customers than it does to renegotiate with current customers. And that's their job. So don't feel embarrassed or unsure or have anxiety about asking for a discount. That's their job. They want to keep you as a customer. And then I mentioned this also, and your employer may have a really nice insurance policy or a partnership with an insurance company, and you may want to look at that as well. Any questions on car insurance? Okay, moving on to homeowners. So homeowners insurance is different than mortgage insurance, and we'll talk about that a little bit. But
Oh, wait.
Oh.
Mariah, I'm sorry.
Go ahead.
There is a question on car insurance.
Okay.
They put it in a different area of the question and answer feature. So, all right. So this is kind of a scenario here. Let's say I have a car that's like 25 years old and it's worth about $4,000. If I choose a high deductible insurance, how much might that deductible be? And could it be higher than the car's value? Is it more worth it in case just to lower the deductible?
Because your car is only worth $4,000, I would have a high deductible. They are not going to give you a deductible of, there's no point in having a deductible of $4,000 because their insurance isn't going to pay you anything because the deductible is that high and your car's isn't worth that much. If your car is only worth $4,000, most people are going to tell you to have a higher deductible. The highest I've heard is $1,500, but I am not an insurance agent, so I don't know that for sure. On all of our cars, because they're salvaged or used, we always have a high deductible of $1,000. It just doesn't make sense other than that to do that. But again, you want to think about that. How often are you on the road? If you're driving all the time, maybe you do want a lower deductible. I don't know, but I think for a car that's that reasonable, I think having a higher deductible makes the most sense from a budget standpoint. From an insurance standpoint, that would be a conversation that you would want to have with your agent.
Perfect. Okay, great. That was the question we had on cars. So let's move on to homeowners insurance.
Okay, woohoo! I don't know how many of you guys own a car or own a house, but when you do decide to buy one, you are going to want or have to have homeowners insurance. And there's four different components of homeowner insurance. There's going to be the structure, the personal belongings or the items inside your home, the liability protection. If somebody gets hurt on your property or inside your home, you're going to be responsible for that. And then any additional living expenses. So if you are displaced and need to move out of your home, let's say because of a wildfire or hurricane or something, parts of that insurance policy will pay for your new living arrangements for a certain amount of time. So I probably went a little too fast, but the structure is going to be the part of the homeowner's insurance policy that will help repay or repair or rebuild your home and attached structures like a garage or patio, front porch, things like that, if they're covered by some, let's say, hailstorm or flood or anything like that. And it seems to be happening more and more with all these hurricanes and fires and things like that. So you're going to want to make sure that that's covered. And then ideally, when you're thinking about this, you're going to want to make sure that your coverage is equal to the home's replacement cost, not the home's value, but the replacement cost. And the cost of rebuilding can be higher or lower depending on its location and the condition of the home and other factors. So if you were on beachfront property in Malibu, the value is going to be much higher than the replacement cost because everybody wants to live on the beach. And then the personal belongings, that's going to cover everything in your home besides the house itself. So appliances, clothes, furniture, electronics, sporting equipment, all that stuff. Even your refrigerator and the food in the refrigerator will be covered. And that coverage kicks in if your belongings are destroyed, stolen, or vandalized. And then, of course, in general, you're going to want to have a much as coverage to replace as many of those belongings as possible. So it's really going to be important to itemize everything in your home, or better yet, take a quick little video of everything in your home, especially when it comes to jewelry or china or things like that, because the insurance company will take into account the depreciation of those items. So let's say you bought those items 30 years ago for $5,000. Today, it may only be worth $1,000. So you want to make sure that you take that into account when you're creating that policy as well. Liability coverage is going to be part of your homeowner's policy, and that's going to kick in if someone gets hurt on your property. So if your dog bites the neighbor, you will probably be held responsible for that. You will want to ask your insurance carrier if there is a premium or if there is just an outright denial for certain breeds of dogs, pit bulls, German shepherds, things like that. So you want to make sure that you have that conversation with your agent. If somebody falls on your property, or if they're uninvited, if you have a pool and somebody, God forbid, drowns, all of that's going to be part of that personal liability, and you're going to want to make sure that you have enough for that. If you have a tree in your driveway and it falls on your neighbor's house, guess what? You're going to be liable for that. So you're going to want to make sure that you have all of that as well. If you have a guest over that gets inebriated or drunk and gets hurt, you will probably be responsible for that. If you have a housekeeper or gardener that gets hurt on your property, you might be held responsible for that. So most of homeowners insurance policies have at least $100,000 in liability coverage, but I think that is not nearly enough. I think you want at least $300,000 and more if you can afford it. But again, it depends on your lifestyle and your home and things like that. If you don't have any parties at your house and you don't have a pool or a trampoline, maybe you do want it lower. It just depends on you. And there's also things called an umbrella policy, where it covers, a whole gamut of things. So you'll want to discuss that with your agent as well. And additional living expenses are really important. During the Creek Fire a couple years ago, our family home was severely damaged, and we lost several structures on the property. We had 5 acres, and my dad had to relocate and move, and they paid like his rent for 8 months. And then they provided a cost of living expenses like food and gas and things like that. So it was really a nice benefit that he had that. And you'll want to do that, especially if you have a home in an area that's prone to natural disasters. And then you'll want to have, let's see, when you're factoring in the cost, a couple different things. Credit ratings sound familiar, anybody? Again, it's going to determine how likely you are to file a claim and how expensive that claim is going to be. So the higher your credit rating, the lower you will have to pay for insurance. And of course, quality and location of a fire department. If you are a block away from the fire hydrant versus half a mile away, you will be paying less because the fire department can hook up and put out the fire much quicker if you're a block away versus a half mile away. Location of the home. Are you in a rural area? Is it hard to get to? If it is, it'll probably be more expensive to insure it. And for example, my dad's place was on Peterson Road. It was 3 miles in, and there's only one way in. That was extremely difficult to defend that home. And he paid a lot for it. He pays even more for it now. But it really does depend. Roof conditions play a major part. You'll hardly see any wood shake roofs in Fresno anymore. Everything is going to be a comp roof or tile, things like that. How old is the roof? Is it new? Things like that. That will always be a determining factor. And so when you're buying a home and you do your home inspection, that would be one of the number one things I would recommend is make sure that you get an inspection on that roof, because it will affect your homeowner insurance policy. And then the quality of construction, obviously, if you have a newer home, there's much more updated safety features, as far as electrical goes, things like that, versus an older home, or vice versa. If you have a lot of updated features like alarm systems and I don't know, there's so many fancy things in these new homes now, but that may affect it as well. So you'll want to have a conversation with that. Flood and earthquake damage are typically not included in your homeowner's policy. That will be something that you will have to add. So again, if you're living on the coast and a tsunami happens and you don't have flood insurance, too bad, so sad. Earthquake insurance is something you have to pay extra for here in California. So you'll want to think about all those things as well. If you have a swimming pool and a diving board, your rates will go sky high. So if you're just starting out and you're just trying to get your foot in the door and own a little piece of real estate, my recommendation would be to buy a home without a pool, without those things, because it will also lower your monthly premium for your homeowner's insurance, and that affects your budget. And then maybe once you get used to those house payments, maybe you decide that you're having kids and you want to have a house with a pool, then upgrade at that point. But there's no, if you can't really afford it and you don't think you're going to use a pool, don't buy a house with that. And again, the deductible, the higher the deductible, the lower you'll pay each month, and vice versa. Things you'll want to consider: homeowners versus mortgage. Homeowners is going to cover you personally. And it's going to be mandatory for anybody that's financing their home. I don't know anybody that's bought a home outright in all cash. So anytime you're financing or getting a loan for a home, you're going to have to get homeowners insurance. This is an example I just found for 2022. If you have a $250,000 home, you were going to be paying an average of $1,300 a year. So a little over $100 a month for homeowners insurance. Mortgage insurance is going to cover the mortgage lender. And this is in case you die and you can't pay your mortgage anymore, the lender is going to be protected. And it's also going to be mandatory for any borrower that's making a payment or a down payment that's less than 20% of the purchase price. So if you say you have a $200,000 home and you only want to pay $20,000, which is 10%, you will have to get mortgage insurance. But if you pay $40,000 or 20%, then you don't have to pay it. One thing to consider is if you get an FHA loan, that PMI insurance is going to last the entire life of the loan unless you refinance. The difference is that if you have, let's say you make 10% and you have a different type of loan, once you pay your monthly bill or your monthly premiums and you earn enough equity where you have at least 20%, then you can call that mortgage insurance company and say, I would like to remove PMI. You can do that. With an FHA loan, you cannot unless you completely refinance. The average that you're going to pay on PMI is anywhere between just a little over 0.5% to almost under 2% on the loan amount. Again, that depends on your credit. So however you have to pay, whatever percentage you have to pay is going to depend on your credit score. So you're going to want to make sure that your credit score is where it needs to be. Any questions on homeowners versus mortgage? Kind of pass through this quickly because
yeah, we have a few questions. So
okay.
let's see. Does homeowners insurance also cover commodities like gold or other appreciating items?
If it's in your home. But if you want it to be appreciating, what you'll want to do is have that policy or have that add-on say that, but you will be paying more for it. Okay. So for example, and my dad had several, he's a retired sheriff's officer and had several collector guns that were destroyed in the fire, and they were worth more now than when he bought them. He did not get enough for that. They had to fight and they had to come to an agreement on the estimated value of that. And that's still an ongoing process with the insurance company. So if you don't want to have that discussion and don't want to have that argument, you're going to need to pay more for it. But if you have gold in your house, it should be in a bank. You shouldn't be in your home. You should get a deposit box.
Okay, let's see. I guess you were talking about trees earlier. So my landlord is cutting down a tree today in my backyard, in the backyard. Does he need a permit? No.
No.
Yeah. All right. And let's take a look. There was one that came up. Let's see. The good student discount, this goes back to the car insurance. Does the good student discount apply after college? Probably not, right?
No, actually it does. I have 2 kids in college and they both have a good student discount.
But after college?
Oh, after college? No,
Yes.
no.
Okay.
You're an adult by then. You're all done with all that. You have to have your own health insurance. You're gonna have to pay your own car insurance. Yeah.
Yeah. And then this is a follow-up to the one about the gold and other appreciating items. What kind of proof do you need of items and their worth?
That's a great question. So, for example, let's take the example of wedding rings. If you have an appraisal, and you can show proof of that will help in your cause. So again, those types of things you may want to consider a safety deposit box for, or a safe or something like that. But if you don't have those things, that's okay. But take a picture of those, because if your appraisal burns in a house fire, you're out of luck. But if you have a picture of it and you can pull it up, or if it's on the cloud somewhere, that will help. So take pictures, take video of all of that things. But if you're worried about jewelry and high-end things like that, you will always want to get it appraised so that you can show that to the insurance carrier, and that will be half the battle.
Great. Yeah, it looks like those are the, one more question. Well, yeah, I mean, if you're a current student, can a good student discount apply to a 50-year-old who is attending college full-time?
That I don't know.
Okay.
I don't know the answer to that. I'm going to say no, but I really don't know. And the reason why I'm going to say no is because health insurance, for example, you can only be covered by your parent until I think age 25, 26, somewhere around there. I think that may apply as well. And because you're 50 years old, you've been driving a long time. So I'm assuming that you won't need that student discount. And so that wouldn't be offered to you because you have a good driving record. But I would ask, why not?
Okay. Seems like they're asking a lot of questions now that you're answering, but if you feel free, if you want to move on, if you have other content that you feel we need to get through, we can do these at the end. What do you think? You want to answer them now, or do you want to wait?
Let's answer them now. I just want to be respectful of everybody's time. So,
okay.
Yeah.
So we have about, another 15 minutes.
Yeah, let's do it. Let's answer.
So does home insurance cover what's on your property or what's in your house, car, in a garage versus driveway, a field?
Yeah.
Okay. Sounds good. Can you explain the difference between cost replacement versus cost of home again?
Yeah. So let's say, let's say I have a house in Malibu, which, whatever, never gonna happen. And then I have a house in Fresno. Obviously the house in Malibu, and let's say the house in Malibu is the same exact size, same exact floor plan, is exactly the same as the one in Fresno. The house in Malibu is going to be worth way more than my house in Fresno. And that's because of the location. It's on the beach, it's in California, it's, in the land of the beautiful people. But if that house burns in Malibu, the cost to replace it is not equal to its value. It may only cost $200,000 to replace the home, but the home in reality is worth $1 million. So when you're paying for homeowners insurance, you don't want to pay a premium based on that $1 million value. You want to pay a premium based on how much it's going to cost to actually replace the home. Now, if you buy a house, if you have your house in Fresno, and it's obviously not worth $1 million, let's say it's worth $400,000, but it's going to cost, $300,000 to replace it. It's still going to cost you less than its actual value. So you don't want to pay for what your home is valued at. You want to pay for what your home is actually going to cost to replace it. Now, if you're worried, if you're thinking you're never going to rebuild, then obviously you're going to want to have a premium or coverage that's going to pay you for the value of the home. But construction costs are what we're referring to when we say the cost of rebuilding. So like, for example, last year lumber went sky high and it was very, very expensive. And people were caught short because they didn't have enough insurance coverage for rebuilding costs. So you want to focus on the rebuilding costs of the home and not what the home is actually valued at, because your value is going to include the land, and it's going to include all the improvements, plumbing, electricity, things like that. But to rebuild it, it's going to be a lot less expensive than if you were to just sell it on the open market. Does that make sense?
Yeah, that makes perfect sense. Okay, so another homeowner insurance question has to do with like proving if you had the item. Should you take the pictures of the items inside your house, or can it be a picture of it from anywhere? Like if you you found it on the internet, I mean, but as long as you have like a receipt, right? Or
Yeah,
a
so
picture.
you'll want to, and I can only speak to my experience in that we went through this with my family, but basically if you have receipts, especially for large ticket items like appliances, furniture, things like that, I would save those things. And then I would definitely take pictures of them and I'd print it out and attach them to the receipt so that the insurance company knows. And then store them off-site somewhere or store them in a safe. Insurance companies are very good at detecting if they found something on the internet. So, be wary of that because you don't want to get in trouble for insurance fraud. They will go after you for that. I will say when it's a true catastrophe or a natural disaster like the fire, the insurance company wants to make sure that you're taken care of and you're made whole because that's what we're paying it for, right? We're paying for this huge thing. And so they will cover you. But if they find out that you've committed fraud or whatever, then obviously you're going to get in trouble for that. But when it comes to those details, like for example, we had a bunch of kayaks that melted and we paid $800 for them. They only wanted to pay us $100 for them because they were 8 years old. So that's that depreciation. So think about that. I always keep my receipts and a picture of it in a binder, and then we put it in a safe at home. That's what I would recommend for you guys.
Yeah, those are really good strategies to think about. So, all right, last question, and then we'll move on. So,
Okay.
This is kind of an interesting scenario. So, what if a home is part of a mixed use property, like a studio above a mechanic shop?
Mhm.
Is the space used for non-residential purposes insurance differently, despite it all being the same building and property?
That's a great question for an insurance agent. That's a very, very good question. I think you're going to want to have a commercial property insurance coverage for your business down below. And then if that is a private residence for personal use, then you're probably going to want to have homeowners or renters insurance, whatever. I would have that conversation with your insurance agent. My guess is, because I own a business, is you're going to have a combination of both because the liability is much different. If you have a customer in your mechanic shop down below, chances are they're going to be more inclined to sue you because you're a business versus that same guy going upstairs and having a soda with you and tripping. He probably wouldn't sue you over that. So you'll have two different policies. I think you're going to want to keep that separate because especially if you're a sole proprietor, you are going to want to protect your home. You don't want to lose your home because of something you did in your business. So you're going to want to separate those two things.
Okay, great. So I think that's it for those questions. So,
all right, cool.
Yeah.
Let's move on to the very exciting health insurance. We all know we need to have health insurance. We all know it's a federal law. And you just have to have it. Like you'd be crazy not to. But there's basically 3 different types. You've got health, you've got dental, and you've got vision. And health insurance is no longer optional, and everybody has to have some type of coverage. So you can either get that through your employer or your spouse's plan, or you can purchase an individual plan, for example, Covered California, things like that. It is not mandatory to have dental or vision insurance. And I say that because if you don't have eye issues and you don't need glasses, and then let's say someday you decide that you do need glasses, it's really like you can go to Eyeglass World and pay $100 versus the $20 a month you pay for vision insurance. So you need to ask yourself if you really do need vision insurance. Same thing with dental insurance. If you've got a history of great teeth, great hereditary genes, and you don't have a lot of dental issues, maybe you're willing to risk having to pay out of pocket for something versus paying monthly premiums month after month, year after year. That's just something to consider. I don't know. I personally have it all because I'm a freak. I'm just a freak like that. I'm afraid something's going to happen. But especially, I would not do dental or vision if you have children that don't have teeth. If they're really young, if they're babies, you don't need to have dental insurance for them, and you don't need to have vision insurance for them until they get older. So when you sign up, and let's say you have your first child and you sign them up for insurance, just sign them up for health insurance. And then when they get older, then you can add the dental and the vision component as well. But those are some ways that you can save on your monthly premium. Some big things that you're going to want to consider, especially with your employer, is the difference between an FSA and an HSA. And the FSA is something that's offered through your employer, and all employees are eligible, and you can contribute up to $2,800 pre-tax. Now, there's a couple benefits to that. If you donate the maximum amount, that's going to lower your taxable income at the end of the year. So when you file taxes, instead of saying you make $60,000, you're actually going to make $57,200. And so you won't have to pay as much in personal taxes. And then you can use that $2,800 and use it for medical care or child care, but it doesn't earn interest. And if you leave that job, that account is forfeited. You can't take that account with you. And you can't change the contribution amount after it's been made. So they're not going to take $2,800 out of your paycheck. They're going to take a monthly amount out of your paycheck to fund the FSA. But they give you that fund, that fully funded, even though you haven't paid into it at the beginning of every year. So the HSA is a little bit different. And I actually really like this for a couple different reasons, but there is one caveat. You have to have a high deductible health plan. And to be considered a high deductible health plan, you have to have a deductible of $1,400, which means you're going to have to pay $1,400 out of pocket before your insurance kicks in. So the government thinks, man, that's a big chunk of change. Let's help these people. So then they came up with this HSA. And basically you can contribute up to $3,650 for an individual or $7,300 per family pre-tax dollars. So you're getting a tax break there. And then any interest earned in that account is also tax-free. And then any money that you spend out of that account that's on a qualified medical expense is not taxed, it's not penalized. So it's kind of like a triple threat. It's kind of a cool deal. But it's going to allow you from withdrawals from medical care. It's going to, you can keep this account even if you change jobs. It follows you because it's separate for your insurance. And then you can change your contribution amount throughout the year, which is kind of nice. And then you can obviously, key difference here is you can only have access to funds that have been actually contributed to the account. So let's say in January, the FSA person has $2,800, whereas the person enrolled in the HSA has only contributed $200. You only have access to the $200 to spend. One thing to keep in mind with the HSA is after you reach, I believe it's age 65, you can actually use those funds for anything. So it can be considered another way to plan for retirement. And as we get older, for a couple that retires at 72, it's predicted by the time they retire that they will have combined medical expenses of over $400,000. So something to think about as you get older and plan your retirement. But they're a little bit complicated, but definitely worth it. I highly suggest them because it lowers your pre-tax or your taxable income. I think it's a great alternative. And the HSA, if you're able, it grows in an account, and so it grows interest, which is really nice. So I would encourage you guys to do this, especially with the FSA, because you can pay for childcare with that and things like that. So it's pretty nice. Just really brief on that health insurance, because there's so many caveats, and I'm not a health insurance professional, but I will try to answer any questions if anybody has it on health insurance. Nope. Okay, cool. Life insurance, basically two different types.
Wait, we have a couple questions.
Right.
Let's see. Umbrella policy. Is there information about that, or
For health insurance?
I don't know. It just says umbrella policy, so I guess for health insurance.
To be honest, I don't know.
Okay.
I don't know about that. Yeah, I know that there's umbrella policies for homeowners and for vehicle insurance.
Okay. I think that's it, really. Yeah.
Okay.
Yep. Perfect. Move
How
on.
much time do we have? Or again, I don't want to overstay my welcome. Okay, we'll finish this up really quick. Life insurance, there's two different types, term and whole life insurance. Basically, term is set for a predetermined amount of time, 5, 10, 15, 20 years, or until somebody reaches age 65. Whole life insurance is where you pay monthly premiums, forever until you decide that you don't want to. The policy for term insurance generally remains the same, and it's really simple to understand, and it costs a lot less than whole life insurance policy. But the difference is that the protection is only available during the term of the policy. So for example, my husband and I have term health or life insurance, and we did that until we reached age 65. And the reason we chose that is because by the time we're 65, we're going to be retired. We will have plenty of money saved up where we will have enough money to cover our funeral expenses and leave money to our children. We don't need a life insurance policy to leave a legacy to our children. So we don't want to pay a life insurance premium past that age point. Now, some people do like the idea of whole life insurance because it offers a death benefit as well as a cash value component. And it's usually between 1% and 2%. And you can maybe, in some cases, take a loan out on that money and then repay it back. And then it locks that premium in for life. So if you start a life insurance policy, a whole life insurance policy at age 25, that premium amount is going to be the same till you decide that you want to stop it. So those are some things to consider. I also don't personally, you'll have this, again, it's a total personal choice, and I'm not going to be held liable for any of this, but life insurance really depends. Do you really need it? Like, if you're single and you don't have kids and you don't have a house and you don't have a lot of debt, then maybe you don't even need life insurance. But if you have children, if you have debts, if you have a mortgage, and you want your family to continue their lifestyle after you're gone, then you probably want to consider some type of life insurance. And it just depends on the amount that you want to provide for them. Will you have, do you have any debts that you'll need to be paid off? Any vehicles that will have outstanding loans? Do you want to be cremated, or do you want to go out with a bang and have like live band at your funeral? It just depends on the type of services and events that you want for that. The general recommendation for life insurance is to have a death benefit that is 10 times your salary before taxes. So if you're making $60,000 a year, you're going to generally want to have a life insurance policy that is $600,000. But of course, you can do more or less, whatever you want to do. And then long-term care insurance, this is really interesting. A lot of people are going to try and rely on Medicaid. Given the current state of what's going on, I don't know that I would do that if I were you. Same thing with like Social Security, right? So when you're deciding whether or not you want to do long-term care basically is if you need to live in some type of facility or have somebody come to your home to assist you with basic living needs, bathing, changing, eating, things like that. Your medical care insurance typically will only cover a short period of time, if at all. So this is where long-term care comes. It's kind of like that gap insurance. So when you're determining long-term care insurance, you're going to want to look at your family history. Do you have family that's lived a really long time and a long, healthy life and never needed it? Or do you have some hereditary issues where there's heart disease, diabetes, things like that? Maybe you want to think about that. And then what type of care do you think you're going to want? Do you want to try and stay in your home as long as possible and maybe have somebody just come in your home and help you? Or do you think you want to live in a full-time facility where they cater to your every need? It just kind of depends. But know that long-term care has adjustable features. You don't need to necessarily buy the Cadillac version if the base model is going to be just fine for you. So if you have very little savings and very little income coming in, you may need to rely on Medicaid because maybe you can't afford the monthly premiums. But if someone has $2 million in the bank and a monthly pension coming in, maybe they don't even need long-term care insurance because they have enough money in their bank account to pay for it. But most of us are going to be in that middle ground. And so typically we're going to need long-term care insurance. And the average statistics are that 68% of the American population are going to need long-term care assistance at some point in their lives. So that's where long-term care insurance comes into play. And you don't necessarily want to rely on your family members to take care of you. So many of us start out in one city and then we grow up and move away. So and your kids will move away or whatever. So you don't necessarily want to rely on family members to take care of you. One thing to consider with Medicaid is that you have to draw down all your assets, and they only want you to have like $2,000 in your bank account. You can't own anything. Like it's very, very, very low income people. And so when you're considering long-term care insurance, maybe evaluate some other sources of your income. Maybe you're gonna have SSI coming in, maybe you'll have a pension or something like that. But a lot of people will say, well, I'll just put all my assets in a trust and give it to my son. Well, that's fine and dandy, but keep in mind that California in particular has a look back policy of 30 months. So if you've established this trust 12 months ago, anticipating that you're going to need to use Medicaid for long-term care, California is going to say, can't do that. So you need to plan at least 30 months in advance to establish that trust. Caveat here, you need to make sure that if you do that trust and you hand it over to somebody, you need to understand that it's irrevocable. You cannot take it back. You cannot change the person in charge of the trust. And a lot of people say, oh, well, my son would never do me wrong. He would never do that. I cannot tell you how many times I have heard of people who have taken out credit cards in their parents' names, or sold their home, or not repaired the home, or they've just not taken care of things because they have a drug habit, a gambling habit. They just want a nice new car. I don't know. So be very, very, very careful if you decide to establish an irrevocable trust in a family member's name. You just never know what's going to happen. And any lawyer, anybody's going to advise you of that same thing. Whew. So with all that,
that is a lot. That is a lot of information. So, well, did you want to talk about your last how to contact you or anything? Or
yeah, I mean, if you guys have any questions, maybe you don't want to ask any here. My phone number is right there. You can email me at mariahw@noblecu.com. I should have added that in that slide. I apologize, but Adrian has my contact information, and we are more than happy to help you. Martin can help you. As a credit union, we're different than typical banks. We are nonprofit, and our goal is to make our members more financially well and stable. And we do that by providing personalized service, lower interest rates, and more products. So anyway, even if you're not a member of Noble, give me a holler if you have a question. I'll be happy to answer it. I'll find somebody who can.
Okay, great. And then just everyone, I want to let everyone know that let me see if I could share my screen. I have to take.
Oh, let me just.
I'll have to take access away, and then.
No, go ahead.
So we have a right here on the screen. We have a survey. So if you want to fill out, give us some feedback on today's content, information presented, maybe some future topics we could think about. Definitely, just use your QR code on your phone. It'll take you to our survey, and you can fill it out as well. And then for those of you who came in late, we do the Money Management Center is located in the Frank W. Thomas building, room 104. And in that building, you can come by and you can set up an appointment to talk to one of our Bulldog financial coaches. One-on-one, they're peer mentors. They can give you a variety of information about financial tools that was mentioned. Also, we have a subscription that the university has. If you go to our Money Management Center website, you'll see our system called Unleashed. And on Unleashed, you can gain access to a variety of different videos, articles, calculators, tools related to all different topics related to finance, and insurance is in there, health care, car insurance, credit scores, everything you can think of when it comes to your money. It's on there. So definitely you might want to visit that as well. Let me see. We're over time, so I appreciate the fact that everyone still has some questions. We recorded this, so we're going to be posting this on our YouTube channel. So visit the Career Development Center's website and go to the YouTube channel under the Money Management Center playlist, and you'll be able to watch this webinar from Noble Credit Union. Again, we want to thank you so much, Mariah and Martin from Noble Credit Union, our community partners, and we hope everyone has a great day. Thank you so much, everyone.
Bye, y'all. Thank you.
Bye.